Hello, everybody, and welcome back to the channel. Today, we're diving into covered calls. It's a powerful strategy that lets you collect premium or cash up front while still owning your stocks. So I know the last video we covered selling cash secured puts, which was another strategy that allowed you to collect premium as well. So this is going to be another powerful, like I said, strategy that will allow us to collect some cash flow. So let's go ahead and get started. So today we will be using a real life example with actual numbers from the market on one of my favorite stocks right now, which is called CAVA. If you have never heard of CAVA, let me tell you a little bit about the company and why I actually own shares of it now. CAVA is a fast casual Mediterranean restaurant chain based in the U.S., known for its build your own bowls, pitas, and salads. Company went public in June of 2003 and has since gained attention for its rapid expansion and strong sales growth. Now, CAVA competes with brands like Chipotle in that fast casual space, and investors see this stock as a high growth stock. It's also extremely delicious. So, I always encourage people to own stocks at companies that you actually patronize on a regular basis. It's a great way to pick a stock when you're just starting out and don't know exactly what to invest in. So, if you eat at certain restaurants, or you have an Apple phone, or you wear Nike, those may be some stocks you want to invest in. So we're going to use CAVA today for our example. So let's go ahead and get started. All right, so in this example, you own 100 shares of stock CAVA, ticker symbol CAVA, at an average cost of $75 per share. CAVA is currently trading at $84 a share, and you agreed to sell an option contract at a $90 strike price that's expiring in the next 25 days. All right, so this is a options chain for CAVA in the Webull app. So I just wanted to highlight a few things on the options chain once again, just to get you guys familiar with what to be looking for on the options chain. So at the top, you're going to see the ticker symbol CAVA and the last price it was trading at on Friday. I'm recording this on a Sunday, so the market's closed, but it looks like it closed at $83.99 after hours. So we'll just round it up to $84. As you can see right below that, we are in the April 17th, 2025 expiration date. And if you look over to the right, we're looking at the strike price, which if you look down, we're at the $90 strike price, which the last one sold at $259. We'll just round that to $260. And essentially, remember that when you're dealing with option contracts, you're dealing with 100 multiplier, because each contract has 100 shares. So that $2.59 or $260 will be multiplied by 100, meaning we'll be collecting $260 for selling this particular options contract at the $90 strike price. All right, so breaking down the numbers just once more, we own 100 shares of CAVA at an average cost of $75 per share. The stock price is currently trading at $84 per share. We chose a $90 strike price for our option contract, and we were able to collect $260 in premium for that option. So there are a couple outcomes that will come of this strategy. If outcome number one happens, CAVA stays below the $90 strike price by expiration, and you get to keep the premium collected of $260, and also get to keep your 100 shares. Essentially, you would rinse and repeat with a new expiration date and a new strike price, and continue to collect premium. In this particular outcome, your total profit is the $260 that you collected. In outcome number two, if CAVA is above the $90 strike price by expiration, you still get to keep the premium collected of $260, but you agreed to sell your shares at $90 per share. So let's do a little bit of math on that so we can get our total profit from this. It costs you $7,500 for 100 shares at $75 per share. Remember, we collected $260, and we're selling 100 shares at $90 as agreed upon in the option contract. So that 90 times 100 is 9,000, plus the 260 gives us $9,260. We'll want to subtract that from the cost of the shares originally, which was the $7,500, giving us a total profit of $1,760. So now let's go over some of the pros and cons for this strategy of selling covered calls. So on the pro side, you get to generate income. You collect a premium up front, which provides extra cash flow regardless of the stock's movement. It's also a partial hedge. So the premium helps to offset potential stock price declines. If the stock, maybe you own it at $75, like in that example, and maybe it's down to $70 at the time, and you want to go ahead and just have a partial hedge towards it, this is a great way to do that by collecting some premium against it. It enhances returns in a sideways market. So if the market is in a consolidation period, it's basically remaining flat or slightly up or slightly down, you keep the premium and still own the stock. So it just enhances those returns. And it's a lower risk than naked calls. So since you own the underlying stock, there's no unlimited risk exposure versus you just buying a call outright and having that unlimited risk if the stock price moves in a major way up or down. And on the con side, there is limited upside. So if the stock rises above the strike price, you must sell at the price that you agreed upon, which is essentially capping your gain. So in the previous example, we had chose a $90 strike price, but let's say at expiration, the stock price was trading at $100 a share. Well, you still have to sell those shares at $90 per share, and you're, basically losing out on that $10 extra because you agreed to, sell an option contract at a $90 strike price. So it does cap the gains there. Your stock shares can be called away. So if the stock does hit the strike price before the expiration, you may be forced to sell unless you do buy the option back. So in that example, outcome number 2, where we were forced to sell it at the $90, meaning you no longer will own the 100 shares. And it doesn't protect against large drops. So while the premium does help that you're collecting, it won't fully protect against any significant stock declines if the stock drops, drastically. So this is why we always want to invest in quality stocks. Just like in the previous video in regards to cash secure puts, we mentioned you want to own quality stocks and use these strategies with quality stocks, not, penny stocks or stocks that or in, large debt, things of that nature, because those stocks can definitely be volatile and move on you pretty quickly. And then lastly, it does require stock ownership. So you need to own at least 100 shares per contract, which does tie up your capital, and which can be a con, but it can be a plus because, hey, you're owning shares of a stock that's a quality stock. So I definitely hope that this helps. And if there are any questions, please drop a comment below, and I will be sure to answer any questions or comments that you may have. As always, I thank you all for watching. Don't forget to hit the like button. Please subscribe if you haven't already, and hit that notification bell so that you know the next time we're dropping a video. And until next time, happy trading.